Hi, this is Ken Boyd, the owner of St. Louis Test Preparation. Here's our website, stltest.net, where you'll find the three soon-to-be 4 dummies books, the blog, the podcast, and also links to all of my YouTube videos by type. Really interesting story that I think is a great illustration of the problem of cash that is such a problem for businesses. As I say many times, that the problem I see in business is not that companies don't make enough money, it's that they can't collect cash fast enough and they end up being sold to find somebody who can supply them cash. And an example that we have on the screen that's from a blog that I wrote is from Radio Shack, and happens to be the fall of 2014. And that Radio Shack would soon run out of cash and they would be forced into bankruptcy if they couldn't figure out a way to shore up their finances very quickly. There's a story I referenced from the Wall Street Journal and also from Money CNN. So the question is, if you're in this situation that Radio Shack's in, what choices do you have? And it's a reminder that there's two ways that companies raise money to run their business, either stock or debt. And so one thing that Radio Shack could do would be to go to a creditor and ask them to change the loan agreement to ease the financial burden. And that easing the financial burden could be lowering the interest rate or extending the amount of time they have to repay the principal, the original amount invested. They could sell all or a portion of the company, which I said at the beginning is the way that many firms are forced to handle a cash shortage because the buyer has the cash to operate the business. The least likely example is to issue more equity. The reason that's the most least likely is that given the financial peril that they're in, and you're going to see in a minute just how much peril they're in, it's probably unlikely, given the firm's bleak prospects, that they could find another buyer for their equity. Nobody wants to have more ownership in a business that's struggling so much. An amazing statistic from the Wall Street Journal article is that in early August of 2014, Radio Shack only had about $6,800 in cash per store, which is amazing, a very small number. They did have a line of credit they had access to, but in terms of generating business from ongoing operations, they had very little, if any, cash per store. So because of that, they had to put out a notice through an SEC filing, because they're a publicly traded company, that there was a risk that they would no longer be a going concern. And a going concern means that a company is viable, a viable business moving forward. And to take that a step further, a viable business is one that can generate sales and positive earnings each year. And Radio Shack was getting to the point where they had so little cash they couldn't operate. And if they can't operate, they can't sell anything and make any money. So this whole thing ties into cash turnover, and cash turnover relates to the accounting cycle. Very basic thing. First couple of chapters of any financial accounting textbook. What's the accounting cycle? Well, we spend money on materials if we're a manufacturer. Payroll, we might spend money on inventory if we are a retailer. We create a product or service and sell that product or service to a client. We then collect cash from that sale. And then the whole process starts over, where we use the cash collections to go out and buy inventory or raw materials or payroll, or pay payroll. And you can compare cash turnover to turning a crank. The faster that you turn the crank, the quicker you get dollars in the door. And you also have to think of a way of cash as recovering the costs of the capital investment you make in your business. Operating your company requires you to spend. And the game, as we'll see here in a minute, is to minimize the assets you put in your business and generate the maximum amount of sales. And I've got two examples that I've used for a long time. Used to do business with a plumbing company. Imagine a plumber driving a truck that's a $20,000 truck with $10,000 of equipment on it. You'd be surprised how much cost there is in having equipment to do plumbing and roofing and other services. So that's $30,000 driving down the road. And if your company does $90,000 in sales with that truck and equipment, ignoring depreciation and repairs and gas, you would be turning over your investment 3 times. That is, you're using $30,000 to make $90,000. So 90 divided by 30 is 3, or 3 times. The shop owner has inventory and they have $600,000 in sales in a year. Their inventory turnover, which is sales divided by inventory, is 3. 600,000 in sales divided by $200,000 in an investment in inventory. So again, the name of the game is to maximize your sales while using a minimum investment in assets. This takes us into a template that I can supply you if you like to email me, called financial ratios, because the ratios we're talking about here deal with liquidity, which is your checkbook, and the idea that over the next 12 months, which is what we consider current, quote unquote, for accounting purposes, do you have enough cash coming in the door in receivables, collecting receivables, selling inventory? Do you have enough cash in the door, current assets, to cover or pay for your current liabilities, which is your accounts payable and your accrued liabilities and which might be accrued payroll, etc. So that's the big liquidity issue, and the current ratio is current assets divided by current liabilities, and we want to have at least $1 of current assets to cover every dollar of current liabilities. To skip down, days receivable outstanding is a way of taking your receivables and comparing that to sales to see how many days need to go by for you to collect on your averaged credit sales. So in this example, if you got $100 in receivables and you sell 1,000 in credit sales in a 365-day year, you can see how many days it's going to take you to collect all of your receivables. And it says down here, you can also look at payables versus purchases. How many days it's going to take me to pay on all my payables. And let me cover in the last minute here quick ratio, which is taking current assets but not including inventory as a current asset, because inventory of the things that you collect as current assets probably take the longest to sell. So if you exclude that from the current ratio above, exclude inventory from current assets, we get the quick ratio, which is another indicator of how liquid you are. What is your liquidity? That's as far as we'll get now. If you need the spreadsheet, it's called Financial Ratios. It covers solvency and other ratios as well. A bunch of ratios on here. Again, the website stltest.net lists the links to the 3 dummies books, including the CPA exam for dummies, the blog and the podcast, and the YouTube videos linked by type, by group. Thanks very much for watching. We'll see you next time.